Welcome back to FDVN channel, where we share current legal issues, provide legal English lessons, and connect to build our English skills in the legal field. In today's video, we will learn the vocabulary through judgment, remembering to note the relevant and bold words appearing in the video. Judgment name, U.S. Securities and Exchange Commission v. Siemens Aktiengesellschaft. First, summary of judgment. Summary: the U.S. Securities and Exchange Commission, SEC, has filed a complaint against Siemens Aktiengesellschaft, Siemens, alleging that the company violated the Foreign Corrupt Practices Act, FCPA, during the period from March 12, 2001, to September 30, 2007. Specifically, Siemens engaged in a systematic practice of bribing foreign government officials to obtain business contracts, creating complex payment schemes to conceal the nature of its corrupt payments. During this time, the company made thousands of payments to third parties, with at least 4,283 payments totaling approximately $1.4 billion used to bribe government officials in various countries, including Venezuela, China, Israel, Nigeria, and Vietnam. Although Siemens' new management began implementing reforms to the internal control system in November 2006, illicit payments persisted. The SEC alleges that Siemens violated multiple provisions of the Securities Exchange Act of 1934, including making illicit payments to foreign government officials and failing to maintain an adequate internal control system to detect and prevent such conduct. The SEC seeks a court order permanently restraining Siemens from violating the provisions of the Securities Exchange Act, requiring the company to disgorge ill-gotten gains, and imposing other relief deemed just and appropriate by the court. Second, main content of judgment. Between March 12, 2001 and September 30, 2007, the relevant period, Siemens Aktiengesellschaft, Siemens, or the company, violated the Foreign Corrupt Practices Act 115 U.S.C. Section 78 DD-L, the FCPA. By engaging in a widespread and systematic practice of paying bribes to foreign government officials to obtain business. Siemens created elaborate payment schemes to conceal the nature of its corrupt payments, and the company's inadequate internal controls allowed the illicit conduct to flourish. The misconduct involved employees at all levels of the company, including former senior management, and reveals a corporate culture that had long been at odds with the FCPA. During this period, Siemens made thousands of separate payments to third parties in ways that obscured the purpose for, and the ultimate recipients of, the money. At least 4,283 of those payments, totaling approximately $1.4 billion, were used to bribe government officials in return for business to Siemens around the world. Among the transactions on which Siemens paid bribes were those to design and build metro transit lines in Venezuela, metro trains and signaling devices in China, power plants in Israel, high-voltage transmission lines in China, mobile telephone networks in Bangladesh, telecommunications projects in Nigeria, national identity cards in Argentina, medical devices in Vietnam, China, and Russia, traffic control systems in Russia, refineries in Mexico, and mobile communications networks in Vietnam. Siemens also paid kickbacks to Iraqi ministries in connection with sales of power stations and equipment to Iraq under the United Nations Oil for Food program. Siemens earned over $1.1 billion in profits on these 14 categories of transactions that comprised 332 individual projects or individual sales. In November 2006, Siemens' current management began to implement reforms to the company's internal controls. These reforms substantially reduced, but did not entirely eliminate, corrupt payments. All but $27.5 million of the corrupt payments occurred prior to November 15, 2006. Siemens violated Section 30A of the Security Exchange Act of 1934, Exchange Act, by making illicit payments to foreign government officials in order to obtain or retain business. Siemens violated Section 13(b)(2)(b) of the Exchange Act by failing to have an adequate internal control system in place to detect and prevent the illicit payments. Siemens violated Section 13(b)(2)(a) of the Exchange Act by improperly recording each of those payments in its accounting books and records. Defendant, Siemens is a German corporation with its executive offices in Munich, Federal Republic of Germany. Siemens is one of the world's largest manufacturers of industrial and consumer products. Siemens builds locomotives, traffic control systems and electrical power plants. The company also manufactures building control systems, medical equipment and electrical components, and formerly manufactured communication networks. Siemens employs approximately 428,200 people and operates in approximately 190 countries worldwide. Siemens reported net revenue of $116.5 billion and net income of $8.9 billion for its fiscal year ended September 30, 2008. In accordance with German law, Siemens has a supervisory board and a managing board. The supervisory board is generally comparable to the board of directors of a corporation in the United States in that it oversees management but with less oversight power under German law. The managing board, or Vorstand, generally performs the duties and responsibilities of senior management of a corporation in the United States and includes the company's chief executive officer, CEO, and chief financial officer, CFO. Prior to a recent reorganization, Siemens operated through a complex array of business groups and regional companies. The business groups are divisions within Siemens and are not separate legal entities. The regional companies are wholly or partly owned subsidiaries of Siemens. Background: during the pre-1999 period, the first period, bribery at Siemens was largely unregulated. German law did not prohibit foreign bribery and allowed tax deductions for bribes paid in foreign countries. Siemens was not yet listed on the NYSE and therefore was not subject to U.S. regulation. Undeterred by foreign laws that prohibited bribery, Siemens put several payment mechanisms in place, including the use of cash and off-books accounts. To make payments as necessary to win business, the term Nutzliche Aufwendungen, NA, or useful expenditures, was a commonly used tax law term and was commonly listed on Siemens cost calculation sheets to denote payments to third parties, including illicit payments to foreign officials. Though ASTA rule, Siemens requires 2 signatures on all major documents in accordance with an internal control known as the four eyes principle. Many exceptions to the rule were made to ensure quick access to cash to make illicit payments. Over time, Siemens developed a network of payment mechanisms designed to funnel money through third parties in a way that obscured the purpose and ultimate recipient of the fines. On at least one project, bribes to high-ranking government officials were arranged personally by a member of the Vorstand. The success of Siemens' bribery system was maintained by lax internal controls over corruption-related activities and an acceptance of such activities by members of senior management and the compliance, internal audit, legal and finance departments. Claims for relief. First claim, as described above, Siemens, through its officers, agents, and subsidiaries, corruptly offered, promised to pay, or authorized payments to one or more persons, while knowing that all or a portion of those payments would be offered, given, or promised, directly or indirectly, to foreign officials for the purpose of influencing their acts or decisions in their official capacity, inducing them to do or omit to do actions in violation of their official duties. Securing an improper advantage, or inducing such foreign officials to use their influence with foreign governments or instrumentality thereof to assist Siemens in obtaining or retaining business. Second claim. As described above, Siemens, through its officers, agents and subsidiaries, failed to keep books, records, and accounts, which, in reasonable detail, accurately and fairly reflected its transactions and dispositions of its assets. Third claim, as described above, Siemens failed to devise and maintain a system of internal accounting control sufficient to provide reasonable assurances that, I. Transactions were executed in accordance with management's general or specific authorization, and 2. Transactions were recorded as necessary, I. To permit preparation of financial statements in conformity with generally accepted accounting principles or any other criteria applicable to such statements. And, il. To maintain accountability for its assets. Third, boost your vocabulary. Here is collection of some specialized vocabulary from the above judgment, a systematic practice of bribing, corrupt payment, illicit payments, the Securities Exchange Act, ill-gotten gains, elaborate payment schemes, misconduct, odds, legal entities, wholly owned subsidiaries, partly owned subsidiaries, bribery, kickbacks, unregulated, off-books accounts, internal audit. Practice exercise, connecting words in column A to its proper meaning in column B. You now have 30 seconds. The answer is, misconduct, unacceptable or improper behavior, often by someone in a position of authority or trust. Bribery, an attempt to make someone do something for you by giving the person money, presents, or something else that they want. Legal entities, organization recognized by law as being capable of, unregulated, not controlled by laws, rules, or restrictions. Subsidiary, a company that is owned by a larger company. Here is a list of extended vocabulary related to breaches in securities area. Insider trading equals front-running trading, market manipulation equals stock manipulation, securities fraud equals stock fraud, misrepresentation equals falsehood, breach of fiduciary duty, wash trading equals fictitious trading, short selling equals shorting, churning equals excessive trading, spoofing equals layering, non-public information, inside information equals privileged information, bar from the securities industry. Practice exercise. Connecting words in column A to its proper meaning in column B. You now have 30 seconds. The answer is, securities fraud, a serious white-collar crime that involves deceiving investors or manipulating financial markets for personal gain. Spoofing, a type of market manipulation where traders place orders they never intend to execute to trick other market participants. It's like creating a mirage in the desert to lure someone in. Wash trading, a form of market manipulation in which an entity simultaneously sells and buys the same financial instruments, creating a false impression of market activity without incurring market risk or changing the entity's market position. Churning, overtrading by a registered representative or broker in a customer's account for the purpose of generating commissions and without regard to the customer's investment objectives. Inside information, information available only to those within an organization. And that is the end of the lesson today. If you have any further question, please comment below this video or send your consideration to our email. Remember to subscribe, like and share this video if you find it helpful. Thank you for watching and see you in the next video.